As we step into 2026, the investment landscape is undergoing a fundamental transformation. The strategies that worked in 2024 and 2025 may not be the ones that succeed this year. Today, we're breaking down the 5 critical trends that every serious investor needs to understand to navigate the markets ahead. Whether you're managing a portfolio of thousands or millions, these insights will help you position for what's coming. Let's dive in. Welcome to 2026. If I had to describe the current market environment in one word, it would be polarization. We're seeing unprecedented divergence between winners and losers, between sectors that are thriving and those struggling to find footing, between economic indicators pointing in opposite directions. The AI revolution that captivated markets for the past 2 years is entering a new phase. Central bank policies are diverging globally. Labor markets are showing cracks while certain sectors boom. Understanding these dynamics isn't just helpful, it's essential for investment success this year. The first and most critical trend shaping 2026 is the maturation of the artificial intelligence supercycle. But here's what's changed. We're moving from the hype phase to the prove-it phase. For the past 2.5 years, virtually any company mentioning AI in their earnings calls saw their stock price surge. Investors were willing to bet on potential, on promises, on the transformative power of this technology. That era is ending. In 2026, markets are demanding results, clear paths to profitability, and demonstrated return on investment. Let's look at the numbers. According to JP Morgan Global Research, AI-related capital expenditure has reached record levels, with the technology now spreading far beyond the tech sector into banks, healthcare, logistics, and utilities. This isn't speculation anymore. Major financial institutions are projecting that the AI supercycle will drive earnings growth of 13 to 15% for at least the next 2 years in the S&P 500. BlackRock's 2026 Global Outlook states that as AI becomes embedded in the economy, they expect it to create entirely new pools of revenue in the tech sector and beyond. But here's the critical shift. The market is becoming highly selective. Companies that have poured billions into AI infrastructure without clear revenue payoffs are facing increased scrutiny. Oracle, once a darling of the AI trade, experienced volatility as investors demanded more immediate returns. Meanwhile, companies demonstrating actual AI-driven revenue growth, like those in the semiconductor equipment space or those with proven AI-enabled products, continue to see strong performance. NVIDIA advanced about 40% in 2025, while Palantir Technologies surged over 140%. But these gains came from companies showing tangible business results, not just AI promises. The concentration in AI winners is reaching new extremes. The so-called Magnificent Seven tech stocks have driven the bulk of market gains. But this creates both opportunity and risk. On one hand, these companies have genuine competitive advantages, massive resources, and proven ability to monetize new technologies. On the other, the concentration means the market has become vulnerable to disappointment from just a handful of names. Bloomberg's compilation of over 60 investment outlooks reveals almost universal optimism about AI's long-term potential, with firms from Fidelity to JP Morgan stating that the biggest risk is not having exposure to this transformational technology. For investors, this means your AI strategy needs to evolve. Rather than broad exposure to anything AI-related, focus on companies with clear monetization strategies, strong competitive moats, and realistic timelines for profitability. Look for the infrastructure plays, the companies selling picks and shovels in this gold rush. Semiconductor manufacturers, data center operators, and cloud infrastructure providers with proven AI revenue streams deserve attention. But equally important, be prepared for volatility. Even great AI companies will face sell-offs when quarterly results disappoint or when capital expenditure concerns resurface. There's also a crucial geographic dimension to consider. While U.S. companies dominate AI headlines, the Global South is driving the next major wave of AI adoption. With young, digitally fluent populations and growing access to affordable AI tools, innovation is increasingly flowing from regions that were once considered secondary markets. In 2026, the AI map is being redrawn, and savvy investors are looking beyond Silicon Valley. The second major trend reshaping 2026 is Federal Reserve policy uncertainty and the diverging global monetary landscape. After cutting rates 3 times in late 2025, the Fed finds itself in a delicate position. Inflation remains above the 2% target at 2.8% for core PCE, while unemployment has risen to levels that historically signal economic stress. This creates a classic central bank dilemma: continue cutting to support employment, or hold steady to ensure inflation doesn't reignite. Here's what makes 2026 particularly unique. Jerome Powell's term as Fed chair expires in May, and a new chair will be appointed. This leadership transition comes at a critical moment. According to Goldman Sachs research, their working assumption is that the Fed will pause rate cuts in January before delivering additional cuts in March and June, bringing the federal funds rate down to a terminal level of 3 to 3.25%. However, this forecast faces significant uncertainty given the leadership change and ongoing policy debates within the Federal Open Market Committee. The December 2025 FOMC meeting revealed a committee with more dissenters than we've seen in years. Some governors advocate for a longer-run policy rate as high as 3.875%, concerned about inflation risks. Others estimate the neutral rate closer to 2.625%, focusing on labor market weakness. Mark Zandi, chief economist at Moody's Analytics, predicts the Fed will surprise markets with 3 rate cuts in the first half of 2026, driven by continued labor market softness and political pressure. The CME Group's FedWatch tool, based on futures market trading, points to 2 cuts, likely in April and September. Why does this matter for your portfolio? Interest rate policy directly impacts asset valuations. Lower rates typically boost stock prices by reducing discount rates and making equities more attractive relative to bonds. But the reason for rate cuts matters enormously. If cuts come from Fed confidence that inflation is under control while the economy remains healthy, that's bullish for risk assets. If cuts are driven by recession fears and rapidly rising unemployment, even aggressive easing might not prevent market declines. We saw this dynamic during the global financial crisis and the COVID pandemic, where the Fed cut aggressively but stocks still fell sharply. The global monetary policy divergence adds another layer of complexity. The European Central Bank is on a different trajectory than the Fed, with Eurozone economic momentum expected to improve in 2026 thanks to better credit conditions and fiscal stimulus. The Bank of Japan, under new leadership, with Prime Minister Sanae Takaichi's economic policies, is pursuing corporate reforms that could propel Japanese equities. This divergence creates currency volatility and shifting capital flows that investors must navigate. From a practical standpoint, this environment favors flexibility. Keep duration shorter in your bond holdings to maintain optionality as rates evolve. Consider international diversification to capture opportunities from differing monetary policies. And pay close attention to the Fed's actual language in statements and press conferences, looking for shifts in their assessment of the balance between employment and inflation risks. The third trend demanding attention is the dramatic shift happening in the healthcare sector. After years of underperformance, healthcare is positioning for a significant comeback in 2026. While the broader market increased by approximately 87% since 2020, the healthcare sector delivered only 27% returns during that period. This underperformance created a valuation opportunity that smart money is now recognizing. Several factors are converging to drive healthcare's resurgence. First, the sector is finally overcoming headwinds that suppressed performance. COVID-related pressures on hospital systems and pharmaceutical companies have largely normalized. Policy uncertainty around drug pricing, which created a cloud over the sector, is being replaced by clearer regulatory frameworks. Companies have adapted their business models and are now demonstrating improved margins and cash flow generation. Second, perhaps most importantly, healthcare is becoming a major beneficiary of artificial intelligence adoption. Unlike some sectors where AI's impact remains theoretical, healthcare is seeing tangible, immediate benefits from AI applications. Clinical decision support systems are reducing diagnostic errors. AI-powered drug discovery is accelerating development timelines and reducing costs. Administrative automation is addressing the sector's notorious inefficiency problems. According to Wolters Kluwer Health, clinical-grade generative AI is becoming a trusted co-pilot when embedded in daily workflows, automating documentation, synthesizing clinical notes, surfacing care gaps, and streamlining communications at scale. The numbers tell a compelling story. The digital health technology market is estimated to grow to over $300 billion in 2026. AI investments in healthcare are shifting from experimental to mission-critical. Healthcare organizations that were cautious about AI in 2025 are now embracing it as both state and federal regulations bring certainty to the industry. Health plans are moving away from blanket no AI policies towards strategic implementation of machine learning for efficiency and navigation support. But the healthcare opportunity extends beyond AI. Demographic trends remain powerfully supportive. An aging population in developed markets creates sustained demand for healthcare services and products. The obesity epidemic is driving explosive growth in GLP-1 drugs like Eli Lilly's Zepbound and Mounjaro, which are generating 54% year-over-year revenue growth. Some analysts describe these drugs as the healthcare equivalent of what AI is for tech, a genuinely transformational product category with massive addressable markets. Investment implications are clear. Healthcare stocks are trading at reasonable valuations compared to historical averages, and especially compared to technology. The sector offers defensive characteristics, as healthcare spending is relatively recession-resistant, while simultaneously providing growth exposure through innovative therapies and AI-enabled efficiencies. EY's healthcare sector outlook for 2026 highlights that ongoing migration to lower-cost care settings, investments in value-based and AI-driven solutions, and targeted regional M&A activity represent key levers for growth and transformation. Look for established pharmaceutical companies with strong pipelines, healthcare IT companies enabling the AI transformation, and managed care organizations improving their cost structures through technology. The sector's underperformance has created entry points that may not last as Wall Street recognizes the improved fundamentals. The fourth major trend is what I call the Great Rotation, the shifting landscape of market leadership and investment flows. For 3 consecutive years, markets have been dominated by a small group of mega-cap technology stocks. The concentration has reached historic levels, with just a handful of companies accounting for the majority of S&P 500 gains. In 2026, there are signs this dynamic is beginning to shift, though not necessarily in a straightforward way. Here's the setup. U.S. technology stocks, particularly AI-related names, have valuations that many consider stretched. Credit spreads are extremely tight. The optimism embedded in current prices leaves little room for disappointment. Meanwhile, other sectors in international markets are trading at relative discounts, sometimes significant discounts, to their historical valuations. This creates the conditions for rotation, where capital flows from crowded trades into undervalued alternatives. State Street Global Advisors notes that with inflation trending lower, U.S. policy rates likely to fall. As the Fed addresses labor market softening and policy levers turning stimulative, we have a supportive environment for risk assets broadly, not just the narrow band of mega-cap tech. Vanguard's 2026 outlook is bullish on bonds, but less enthusiastic about U.S. stocks specifically, suggesting better risk-adjusted returns may be found outside the most crowded trades. But, and this is crucial, the rotation isn't guaranteed to be clean or immediate. The AI supercycle remains a powerful force. Companies successfully deploying AI continue to gain market share and pricing power. As BlackRock puts it, AI will likely keep trumping tariffs and traditional macro drivers. So rather than a wholesale abandonment of technology, we're more likely to see a broadening of leadership, where strong performance spreads to more sectors and more stocks within sectors. What does this mean practically? First, consider rebalancing portfolios that have become overweight technology through appreciation. Tax considerations matter, but so does concentration risk. Second, look at sectors that have been left behind but have improving fundamentals. Financials benefit from higher for longer interest rates and improving credit quality. Industrials are positioned to benefit from infrastructure spending and onshoring trends. Energy, despite volatility in oil prices, offers value and income that tech-heavy portfolios lack. International diversification deserves renewed attention. European equities are pricing in significant pessimism despite improving economic momentum. Japanese stocks are benefiting from corporate governance reforms that are unlocking shareholder value. Emerging markets, which have underperformed dramatically, are seeing better economic conditions and more favorable policy environments. The declining dollar, which many strategists expect to continue in 2026, is a tailwind for international returns when measured in dollar terms. Dividend stocks represent another rotation opportunity. During the AI excitement, investors largely ignored dividend payers. You're most likely to find attractive dividend yields from companies in healthcare, consumer goods, and industrials, rather than technology. As growth concerns rise and investors seek more balanced return profiles, dividend stocks that offer passive income regardless of market direction become more attractive. The rotation thesis doesn't require believing AI will fail or that tech will crash. It simply recognizes that after several years of concentrated gains, opportunities exist elsewhere, and a broader rally is possible if economic conditions remain supportive. The fifth and final trend is the infrastructure and energy transition megatrend accelerating into 2026. This one is often overlooked because it lacks the headline-grabbing excitement of AI, but the investment implications are enormous and long-lasting. The transformation of energy systems, the build-out of AI data center infrastructure, and the modernization of electric grids represent trillions of dollars in capital deployment over the coming decade. Let's start with the power-demand equation. Research from Goldman Sachs found that data center power demand in the U.S. will likely more than double by 2030 from 4% of total demand in 2023. AI doesn't just require semiconductors and software, it requires massive amounts of electricity. Each new data center, each deployment of large language models, each expansion of cloud computing capacity translates into sustained demand for power generation, transmission, and grid infrastructure. This is creating a supercycle in utilities and power-related companies. Utilities, traditionally viewed as boring, low-growth dividend payers, are suddenly at the center of the AI revolution. Companies investing in grid modernization, renewable energy integration, and power infrastructure are seeing growth rates that would have been unthinkable 5 years ago. The AI infrastructure boom is as much about electrons as it is about algorithms. Beyond data centers, the broader energy transition is hitting an inflection point in 2026. Electric vehicle adoption continues accelerating, with global sales projected to exceed 20 million units. Each EV represents demand not just for the vehicle itself, but for charging infrastructure, grid capacity, and the metals and materials that enable the transition. Solar and wind capacity additions remain at record levels, backed by hundreds of billions in government incentives through policies like the US Inflation Reduction Act, the EU's Repower EU plan, and China's carbon neutrality commitments. The metal and materials implications are significant. Copper, essential for electrification, faces supply constraints, as mine development hasn't kept pace with demand growth. Lithium and other battery metals have experienced price volatility, but remain structurally in deficit for the transition at the scale being planned. Silver, as we've discussed in other analyses, faces unprecedented industrial demand from solar, EVs, and 5G infrastructure. This isn't a story about speculative commodity trading. This is about fundamental supply-demand imbalances driven by the largest infrastructure transformation in modern history. Investment opportunities span multiple categories. Traditional infrastructure companies, construction firms, electrical equipment manufacturers, and materials producers are obvious beneficiaries. Renewable energy developers and operators, despite some recent headwinds from rising interest rates, are positioned for long-term growth. Grid-scale battery storage companies are addressing the intermittency challenges of renewables. Even traditional energy companies are pivoting, with major oil and gas producers now significant investors in low-carbon energy technologies. The risk factors deserve attention too. Execution matters enormously. Not every company in these sectors will succeed. Cost overruns, permitting delays, and technology obsolescence can devastate returns. Policy changes, while generally supportive globally, can shift quickly with political winds. Commodity price volatility can whipsaw earnings for materials producers. But for investors with appropriate time horizons, the energy and infrastructure transition represents one of the most durable investment themes of the decade. So those are the 5 trends. The AI maturation from hype to results, Federal Reserve policy uncertainty and global monetary divergence, healthcare's resurgence, the great rotation in market leadership, and the infrastructure and energy transition megatrend. Each of these alone would be significant. Together, they're creating a complex but navigable investment landscape for 2026. How should investors position for this environment? Let me offer some practical frameworks. First, embrace diversification, but make it thoughtful. Diversification doesn't mean owning a little of everything. It means understanding your exposures and ensuring you're not overly concentrated in any single risk factor. If your portfolio has become heavily weighted toward a few mega-cap tech names through appreciation, consider rebalancing into some of the opportunities we've discussed. Second, focus on quality and fundamentals more than ever. When markets were rising broadly in 2024 and early 2025, lower quality companies got carried higher. That's changing. In 2026, investors are scrutinizing balance sheets, cash flows, competitive positions, and management execution. Companies with sustainable competitive advantages, strong balance sheets, and proven ability to generate cash will outperform those with compelling stories but weak fundamentals. Third, stay flexible and avoid rigid positioning. The range of possible outcomes in 2026 is wider than usual. The Fed could cut rates aggressively or hold steady. AI could continue driving narrow market leadership, or we could see broadening. Geopolitical developments could shift quickly. Portfolios that are too rigidly positioned for one specific scenario will struggle if conditions change. Maintain some dry powder, keep stop losses on more speculative positions, and be willing to adjust as new information emerges. Fourth, pay attention to valuation, but don't let it paralyze you. Yes, some parts of the market look expensive by traditional metrics, but expensive can get more expensive when fundamental momentum is strong. Conversely, cheap can get cheaper if there are good reasons for the discount. Use valuation as one input among many, not as the sole decision criterion. The goal is to buy businesses that will be worth more in the future, not just things that look statistically cheap today. Fifth, consider the time horizon for different positions. Some of the trends we've discussed, like the AI transformation or the energy transition, will play out over years or even decades. Other dynamics, like the Fed's rate path or quarterly earnings reports, operate on much shorter time frames. Structure your portfolio to capture both. Core positions in secular growth trends that you can hold through volatility, and more tactical positions sized appropriately for their shorter-term nature and higher risk. One final thought on risk management. The market concentration we discussed, where a small number of stocks drive the majority of gains, creates a fragile structure. If those leaders stumble, either from disappointing results or simply from exhausted momentum, the broader market could experience turbulence even if underlying economic conditions remain solid. This isn't a prediction that such a stumble will happen, but it's a risk factor worth acknowledging in position sizing and portfolio construction. For those focused on income, the environment offers interesting opportunities. With the Fed potentially cutting rates, but not dramatically so, we're in a sweet spot for certain fixed income strategies. Short to intermediate term bonds offer attractive yields without excessive duration risk. Dividend-paying stocks in sectors like utilities, healthcare, and consumer staples provide income with potential for capital appreciation if the rotation thesis plays out. Real estate investment trusts, after being hammered by rate increases, are starting to look interesting again as the rate outlook stabilizes. The international angle deserves re-emphasis. U.S. investors have home country bias, which has served them well given U.S. market outperformance. But valuations, currency dynamics, and improving fundamentals in regions like Europe and Asia are creating opportunities that may offer better risk-adjusted returns over the next several years. This doesn't mean abandoning U.S. exposure, but it does mean considering whether a 10 or 20% allocation to international developed and emerging markets makes sense. As we wrap up this analysis, I want to acknowledge what we don't know. We don't know if the Fed will cut rates once, twice, or multiple times in 2026. We don't know which AI companies will be the ultimate winners and which will fade. We don't know if geopolitical events will disrupt markets. We don't know the exact path of economic growth, inflation, or employment. What we do know are the trends in motion, the fundamental drivers at work, and the frameworks for thinking about risk and opportunity. The 5 trends we've covered provide a roadmap for navigating 2026. AI's maturation creates opportunities for selectivity, rewarding companies with real business models while punishing those with empty promises. Federal Reserve uncertainty demands flexibility and attention to both growth and inflation signals. Healthcare's resurgence offers value and growth at reasonable prices. The rotation thesis suggests broadening leadership if conditions support it. And the infrastructure and energy transition provides durable long-term investment themes independent of quarterly market noise. For investors willing to do the work to understand these trends and position thoughtfully, 2026 offers significant opportunity. The key is avoiding complacency, staying informed, and maintaining the discipline to stick with sound investment principles even when markets test your conviction.